Corporate finance practice problem using Excel. Acquisition, uneven returns, problem number 1. Get ready, it's time to take our chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet, would like to follow along, note that we're in the practice tab as opposed to the example tab. The example tab in essence being an answer key. Information on the left-hand side, we're going to populate that into the blue area on the right-hand side, considering an acquisition situation, one company thinking to purchase another company, cost of doing so, $7 million. We then have the inflows that we're estimating from the acquisition. We have the cash inflows that are direct, and then the related benefits, which you might call synergistic type of benefits, meaning our current operations we're expecting to be able to be increased and advanced due to the acquisition. So years 1 through 5, we're expecting those to be $710,000 and $62,000. Years 6 through 15, we've got the $926,000 and $82,000, and 16 through 20, $1,010,000 and $92,000. The cost of capital, the rate we're going to use for our discount rate when we do the net present value calculation at the 11%. Now note this is going to be very similar to a capital budgeting type of project situation as we think about this long-term impact of this long-term type of decision and figure out what we think, whether it be a good decision or not using the net present value types of calculations. We're not going to go to different formats of present value calculations. We're simply going to use Excel. If you want to look at present value calculations in more detail, using tables, using formulas, you can look at a prior section there. And if you want more work on just this net present value calculations in general, you could take a look at the capital budgeting section. So there's a couple different ways we can do this. Notice that our goal here is to try to use that discounted rate and basically bring it back to the current period using a cash flow basis, present value the cash flows, and see whether or not it would be beneficial for us to do so. You'll note that in this scenario, we've got these groupings that are kind of the same results for a period of time. Therefore, we might use an annuity type of calculation in order to figure those out, or we can just basically list the entire thing out basically for the whole, looks like 20 years here, and just take the present value of 1. Now, there's pros and cons to either method. Obviously, if it was a test question, then they may do this purposely so that they could force you to, you could do this kind of complex calculation with the use of annuities. It would be smaller to do so. It'd be a little bit easier possibly to do so. And it might be nice for presentation purposes because you can kind of group things together possibly in that way. However, if you break something out year by year, then you actually get to see the year by year cash flows, which can be nice as well. However, somewhat overwhelming if you're looking at 20 years. Let's do it both ways. Here, I'm going to start off with just basically listing the whole thing out in 20 years, what we expect the inflows to be. And then we'll take the present value year by year. And it's really pretty easy to do that in Excel. And then we'll do the second method. So I'm going to just put up the years here, 1, 2. I'm going to copy those two. Or not copy them, I'll use the autofill, grabbing the autofill handle and dragging that autofill handle all the way down to 20 periods. 20 periods. Actually, I'm at 21 periods. The last one's going to be a total. Let's bring it down to 20. Okay, and then we're going to center that. I'm going to go ahead and alignment and center that. Then I'm just going to pull the amounts in. So for the first 5 years, we've got the 710 and the 62. The total benefit is basically between the two, meaning the synergistic benefits or the increase in our production level due to the added assets that we're going to get are going to be the 62 plus the 710. So the total benefit is the sum of both of them. So I'm going to say this equals the sum. That's, my fingers are on the wrong key. The sum of these two, the 710 and the 62. And then I'm just going to basically copy that down to 5 cells here. So you could do that with an absolute reference up top. But I like to oftentimes just say equals the one above it in the second cell, and then I can copy that one down using the autofill, and everyone just is representing the one above it. It's another way. Sometimes that's useful to do. Sometimes the absolute reference up top and copying that down is easier to do, whichever method you prefer. From 6 to 15, we got the sum of these two. So I'm going to do the same thing here. This equals the sum of the 926 and the 82. And then I'm going to do the same thing here. I'm going to say equals the one above it, and then copy that down to 15. So we have 10 years here, it looks like. Is that 10 years? think that's 10 years. So there we have that. And then lastly, we've got from 16 to 20 is going to be equals the sum of these two. Closing that up, I'm going to put the one underneath it equals the one above it, and then autofill that one down, grabbing the fill handle, dragging it on down. And the last one here is going to be our total. I'll just call it a total. So that means total cash flow, if I was to sum this on up, if we were to do this, would be the 19,450,000 we're estimating versus the outflow of the 7 million. But we got to discount it at the 11% interest rate, considering this is a 20-year out project. So I'm just going to do the present value of 1 all the way down, taking each one back. And notice the format of the table makes it nice and easy to do that, because I've got my years here that I can use in the formula and copy that down instead of hard coding the years. And then we can just basically copy the thing down. So let's do it a couple times, and then we'll copy it down. So I'm going to say this is going to be negative present value. Also, I'm going to do this a little bit more quickly, because we've seen these in the net present value capital budgeting section. So we've got the rate is going to be the 11%, and then comma, the number of periods. Notice I'm picking that up right to the left here, which is going to be that number 1. I'm not making this first one, an absolute reference yet. I'll come back and do that later. I'm just going to calculate a few of them just to get an idea of what we're doing. And then comma, we're not going to be doing an annuity. We're just going to be doing present value of 1s all the way down. So 2 commas, or you can put a 0 there. And then I'm going to pick up these 772 and enter. Let's do that a couple times down to like number 6, and then we'll do the copy and paste thing here. We won't do it all the way down 20 periods, so don't worry. So I'm going to say negative present value, shift 9, rate, the 11%, comma, number of periods is now 2, which I'm picking up in the column here, which is very nice and convenient, comma, comma, future value, there we go. So the second one, of course, is less than at the current point, because we brought it back 2 periods as opposed to 1 period. Let's do this one. This is going to be the present value, shift 9, 3 years out, 11%, comma, number of periods is now 3, comma, comma, future value, same 772. Let's do it again. Negative present value, shift 9, rate, comma, number of periods is now 4, comma, comma, future value. Let's do it 2 more times just to get this down. Negative present value, shift 9, rate, 11%, comma, number of periods 5, comma, comma, future value 772. Now we have a different dollar amount. You can see what's happening with the same dollar amounts. They're going down as the years go out because it's present value. Let's do it one more time on the different dollar amount. Present value, shift 9, rate 11%, comma, number of periods is now 6, comma, comma. Now we're at the 1,000,008. So there we have that, 1,008,000. Okay, so then that brings it back to the 538. Now let's do it one more time using our absolute references and then copy it all down. So I'm going to delete what we have done and do it the easy way this time. The easy way. That's the way we like to do things. The easy way, as long as they're not like shortcuts that take away from like the benefits. So we're going to say now this one's outside of our table. So I'm going to say F4 on the keyboard, $ before the B and the 10, making it absolute. You only need a mixed reference, but absolute works. Comma, number of periods is back to that number 1, which I do want to copy down, so I'm not going to make it absolute, comma, comma. Future value is that 772, which once again, I do want to copy it down, so I'm not going to make it absolute, and enter. If I copy that down one time, let's just see if it does what we expect it to do. Auto-filling it down, double-clicking on it. These 2 cells look right. It's left that one the same because it was absolutized. So looks like it did what we want. Let's put our cursor back on it. Autofill. Drag that fill handle down to 20 periods. I'll typically double click on like the last one or something. Make sure it's still doing what we expect it to. It is. Let's sum it up. Equals the SUM. Present value then, using the SUM, is going to be the 7,727,000. 414. Now we can compare that. Those are the inflows to the outflow, which is at period 0 of the 7 million. And that'll give us basically our net present value type of calculation. Remember that anything over 0, when I kind of natch these 2 out, would be positive, because this 11% isn't just the interest rate, that includes the cost of capital. So anything that's 0, if it was 0, that would mean that we would have an 11% return, which includes what we want in the return, therefore good. Okay, so then we can do this the other way. We could say, well, let's do this like with our annuity tables. Now, the annuity tables are a little bit more tricky than you would think. So let's kind of figure this out because there's a little bit of a twist to it. But we'd start off with the same kind of thing. We'd say this is going to be the sum of these two for the first 5 years. So why don't I just annuitize the thing instead of doing present value of 1 5 times? So these 5 here, right? We're just gonna basically do this way by saying negative present value shift 9 rate 11%, comma, number of periods is now going to be 5, which I'll hard code this time, and then comma, and the payment is going to be that 772. We're using the payment because now we're using an annuity calculation instead of a present value of 1. So if I had that same payment for 5 periods, then we would be at that 2,853,232, which I think should equal these 2,853,232. So that's good, and that's the same thing over here at present value of 0. Now it gets a little bit tricky when we go to the second one. I'll explain why. Let's do the thing that makes sense. This would be the negatives that equals the sum of these payments again. For 6 through 15, 10 periods, I believe, right? If we counted this out, 10 periods right there. So there's 10 of those. 10, right? 10 count. Okay. So then I'm going to do my annuity for 10, negative present value, shift 9, rate is at that 11%, comma, number of periods is now 10, we said, comma, and then the payment is going to be that because it's an annuity, not a present value of 1. So there we have it. Now, you would think then, like if I added these up, that it would be the same number like that. The 3522 is not the same here. Why? Because we got to bring it back to period 0. That means, because this annuity started at period 6, right? We got to bring it back to basically, or period 5 or 6, or we got to bring it back to period 0 is the point. So now we got to do our present value of 1 calculation, negative present value, shift 9, rate is going to be that 11% again, comma, number of periods is going to be 5, and then comma, because this is like now a one-time number that we did our annuity calculation in. So now we're doing present value of 1, not an annuity. And there's that 3522932, which I think that would equal, if I summed these up this way, like that, the 3522932 equals this number, just like we knew it would. I had complete confidence that that would be the case. So now we're going to do summing this one up for these two, and this one's for 16 through 20. So let's do that annuity. That's 5 years. So equals, or let's say negative present value, shift 9, rate at the 11%, comma, number of periods is now, we're going to say 5. That's 5, right? Yeah, 5, comma. And then the payment is going to be equal to this. It's an annuity again, not a present value of 1, and enter. So there we have it. Now again, this is going to be different because if I was to add these up, these ones, it adds up to 851,249, which isn't that, because we got to bring it all the way back here because that is an annuity that started like 15 years out. So we got to bring that back 15 years, which is significant. So negative present value, shift 9, rate is at the 11%, comma, number of periods is going to be 15, bringing it back, comma, bringing that amount back on back, and we get all the way to the 851,249. That looks familiar. So if I copy these, or if I highlight 851,249, that's why it was familiar, because it's the right answer. And I've seen the right answer before. Total. And then we're going to sum these up equals the SUM. So there's the total amount matching in, or I'm sorry, that doesn't match out. Hold on a sec. Let's sum this across. So there we have that. This annuity probably isn't relevant. And this amount actually isn't relevant either. All we're looking for is this amount over here, which the 7227414 matches this amount out. And then we can compare the outflow and the inflow. So the outflow, which is easy to calculate because it happened on period 0, so we don't need to do anything special to it. Nothing special happening here. Just picking up that number. It's kind of boring. And then we're going to say this is the inflows that we present valued minus the outflows. Now, it's positive, so that would mean it might be a beneficial thing. And remember, even if this was 0, that would mean we got our return of 11%. So it still might be something we pick up even if that was 0, meaning this is not just the inflation rate. This includes our rate of return we're looking for. So if it was anything 0 and above, it might be a beneficial thing to do. Again, if you want more detail on those, take a look at the net present value calculations for capital budgeting.